Hello, everyone. Welcome to First Service Residential's Ask the Experts panel discussion, Condo Insurance and Reserves Demystified. My name is Paul Schwartz. I'm a director in the high-rise division of First Service, and I'll be moderating today's discussion. We will be recording this session and sending it to all the attendees. So note-taking is not necessary if you want to make sure you're focusing on what is being said. We do want everyone to know that today's conversation represents perspectives from our panel of experts. This should not be relied upon as advice specific to your association. So as always, consult your professional partners, whether it's an attorney, insurance agent, reserve specialist, to determine the best course of action for your individual association. So we have a great program for you today. Let's dive right in. Joining me today are Lynn Coulter, Vice President of First Service Residential, Drew Isaac, President of Drew Isaacs and Associates.
Good morning, everyone.
Pamela Malfavon, Director of Financial Products and Services with First Service Financial.
Good morning, everyone.
And last, certainly not least, the attorney of the bunch, Gary Marsh from Siegfried and Rivera.
Good morning. Thank you for having us.
Thank you all for being here. We appreciate it. And thank you all for attending, those that are online. So insurance and reserves. It's no surprise that these are two hot topics in our industry right now. And as we all know, insurance premiums have skyrocketed and associations are desperately seeking strategies to mitigate these rising costs. Senate Bill 154 passed earlier this year, significantly tightening the requirements for milestone inspections and structural integrity reserve study requirements, which also is referred to as SIRS. So these are crucial in ensuring the safety and long-term maintenance of condominium buildings across the state. So we now have two major challenges in our industry, which is why we're all here today. And these challenges are what associations need to address simultaneously, but also very quickly. So let's go ahead and dive right in. We have a lot to cover. So why don't we get started with insurance? So let's start by addressing the rising insurance premiums. Pamela, if you can provide some insight into the current state of the insurance market, that would be great.
Absolutely. So, the market is we're still going through a crisis, an insurance crisis. The market is extremely challenging, extremely limited. And there are many reasons for that. So one of them is that insurance companies have to purchase reinsurance. That's basically what they use, right? What the reinsurance carriers that all of the insurance companies use, these are global carriers that are being impacted by catastrophes all over the world. So when we're talking about what is happening here in Florida specifically, a lot of board members and a lot of people in general have questions to why is it that we're facing such high increases when our building hasn't been impacted, right? Our property hasn't had any claims in the past 5 years. Or really we haven't been hit directly by a major storm directly in South Florida. So we have those questions all the time. But the reason behind part of this big increases is because of this reinsurance rates being so high, again, dealing with global carriers that are being impacted all over the world, and they have higher rates. So insurance companies now have to pay more to pay for their own insurance. And of course, they're passing on to the higher cost to the ultimate consumers, which is unfortunately us, right? So that is one of the reasons. Capacity is another challenge in the market, and that basically refers to how much insurance an insurance carrier is willing to provide. So in the past, we used to have many carriers that would be able to insure a full building. They would be able to take on the entire valuation for all perils, wind and all other perils as we call X-wind. Now there's many restrictions with that. So carriers maybe are only able to offer $2.5 million, $5 million. And so when before we could do one company insuring the entire building, now there's only a few left that can do that. The alternative would be having now multiple carriers in a property layered program in order to provide full limits, right? So that becomes more challenging because if before we could do one and they could charge one rate, now we're dealing with possibly 10 up to 15 carriers in one program alone, and each carrier is going to have their own rates, their own increases, right, that they're comfortable with, and their own valuations that they're or limits that they're willing to take. So that's another big challenge. And one of the biggest challenges is, of course, insurance companies leaving the market. We've had many, many carriers that have completely left the Florida market. And part of it is also because of the exposures we have here with hurricanes. That is definitely one of the factors. and also because of the litigation in Florida. As we all know, Florida is a very litigious state, and a lot of times what carriers ended up doing was settling, right? So whenever there was a claim, and maybe the association wasn't at fault, or maybe the damages weren't as significant, but the claims were still submitted to the carriers. They still have to provide legal costs or incur legal costs, and this is part of the claims that they had to deal with. So after Hurricane Irma, we saw a huge increase in how much insurance companies have to pay, basically, from some of those Hurricane Irma claims that came about. It took a few years to see those big changes in the market, but that really has left or led the carriers to leave the market, to not be comfortable insuring buildings in South Florida, unfortunately. And so, of course, when we don't have enough companies, we don't have competition, right? We're left with only a few carriers. Sometimes we're lucky to even get one carrier to provide renewal terms. We're seeing associations that are being completely non-renewed or canceled midterm, which is very, very unfortunate. This is something that we really didn't see in the past. So that is definitely a big challenge because, again, we don't have many options to choose from. And when we don't have many options to choose from, insurance companies basically have the upper hand, right? And they can charge higher costs. They can increase the deductibles, increase the terms, basically whatever they want to do because, they're in that position where they can do so.
Right.
So that is definitely something that we're seeing now. Part of what we're seeing also is, the questions that we get is what should we expect for next year? And it's a very tough question, right? Because each building is unique. Each building has their own claims history, has their own, unique type of construction, the age of the roof, the characteristics of the building. And so there could be buildings that may be facing a 25% increase for next year. And there are some that may be looking at over 100% increases, depending on, the specifics of the building. So my recommendation is always to reach out to the insurance agent for the association, obtain a budget from them. And again, the budget are going to range. The average that I'm seeing right now is anywhere between 35 to 40%. For buildings without claims and without the need of a new appraisal. We're going to talk about appraisals in a little bit, but we have to take into account now, if the association is due for an appraisal, the rate increase plus the potential rate valuation increase. So those are two that have to be taken into account when we're looking at providing budgets for next year. So all of that is very, very important. It's all part of the process. And Gary, I know we get a lot of questions about the legislation and what is happening. So why don't you, tell everybody about what should they expect for next year in terms of legislative changes?
Well, one of the things I just want to start with, because and Pam, thank you. The associations have to understand that the requirements for insurance are coming from both usually the declaration of condominium in a condominium setting, which mandates a certain degree of insurance and the type of insurance and the limits of insurance. They're baked right into the condominium documents. And I haven't seen a condo document that doesn't have some level of mandate as to what kind of insurance is supposed to be maintained by the association. That is coupled with the statute, the Condominium Act, 718-111, which also regulates and dictates insurance requirements in terms of insurance that need to be procured. So the state has oversight over this for those reasons, because there is statutory mandates and oversight and legislation that deals with these types of things. So the state has obviously recognized, if anybody who's been following the state legislature, they have recognized that this insurance crisis definitely needs redress. The problem is they really haven't tackled it yet. There was a short session at the end of last year's legislative cycle where they called the legislature back into session to try to deal with it. There were some limited modifications. They were mostly due to homeowners, private homeowner insurance, very little with regard to the issues of today on this webinar. But I understood that this is something that the legislature intends on addressing, hopefully through this legislative cycle. I know one of the things that's being considered is an ability to have a fund to go to where you're not able to procure the funds or maintain funds in order to buy the insurance. There may be some methods that are going to be put together so that under certain conditions you can go to a state-controlled fund to be able to get the funding necessary to ensure the building properly. But this is something that definitely needs to be tackled, and there has not been any kind of definitive legislation that has come out of Tallahassee to deal with this as of yet.
So more to come in the future, certainly on that.
Yeah.
Okay. So let's talk about some strategies that boards can employ to prepare for the policy renewals. So one of the questions we got was, what approach should they take to get the most competitive rates? And is it wise to shop around for the best deal? And how early should they start the process?
Yeah, so that's another, great set of questions. It's, again, because the market is so limited, the boards have to look at this in a different way as they have in the past, or as they do with other industries, right? When we're looking at insurance industries or the insurance industry, this is very unique industry where insurance companies only work with one agent at a time. So that means they cannot provide multiple quotes to multiple agents. In the past, when we were in a stock market and there were many carriers available, we could do that. We could split the markets, and we could say back then, 3, 4 years ago, 5 years ago, we could say, okay, agent A, you're going to work with companies A, B, C, and agent B, you're going to work with companies X, Y, and Z. And then we could get 2 sets of proposals, and that was great. There was competition. We could do that. This is certainly not the market to do that because we barely even have 1 or 2 options. So my recommendation, and what we're seeing works the best for all associations, is for the boards to engage in what's called a broker selection process. So instead of doing a market selection, now it's based on the broker. So the boards will then basically interview multiple agents. I would suggest anywhere between 2 to 3 in addition to the current agent, and then ultimately decide which agent basically can provide the most competitive terms for the association. And the way they can pick the best agent basically is looking at, do they have the right experience, the knowledge in the industry, in the market, relationships with the carriers, and the volume. It makes a big difference. Insurance is also about relationships and also about how, the association is presented to the underwriters. That makes a big difference. And we have seen that especially in this market, where if an insurance agent only provides a little, few details about the association, let's just say the association has some construction going on, major construction going on, right? It could be millions of dollars. And if the agent is not basically painting the best picture, right, to make the underwriters comfortable, the underwriters are going to decline the risk. They're going to say, we're not comfortable with this construction. You're not giving me a lot of details. So what I would suggest, and Paul, part of your question was, how can they prepare? What I would suggest is, we have to first look at what are the options? What does the association qualify for? Do they qualify for a ground up carrier, right? Such as a QBE or a Steadfast. If they do, that is really the best home for those associations. I wouldn't mess with that because those carriers can insure the entire building for the full valuation and provide all of the perils. So that is the best case scenario. If the associations are getting those renewal options, I would say take them and run with them, because that truly is the best options in the market. With those particular carriers, there's only a couple, there's only a few really that can do ground up. Now, the next option would be, in my opinion, because of the way the rates are and what we're seeing in today's market, is to look at Citizens. Citizens really was created and was considered to be the market of last resort. Basically, what that meant is that if we could not find coverage with the private market, we were kind of left with Citizens. But that has changed. Citizens actually has become very particular, very strict with their underwriting requirements and guidelines. So they're not accepting everybody like they used to, because again, they can only handle so much volume, right? They weren't set up to handle all of the submissions that now they're dealing with. But I will tell you this, their rates are definitely lower compared to the private market and the layer programs, which that would be the third option. Now, in order to prepare and to qualify for Citizens, there's a lot of things that have to be done. Citizens requires updated appraisals, requires updated mitigation forms, engineering reports if there's construction going on, or if the buildings are older. If the 40-year certification needs to be completed, there has to be details and documentation to support what has been done or provide the timeline for it. Same thing for roof inspections. If the roofs are older than 15 years old, they're going to want to see a roof inspection on their own citizens forms. So there again, a lot of things that have to be done. So my recommendation would be start the process early, see if we can qualify for a ground up carrier. If we cannot, then let's see if we can qualify for citizens and try to get everything in line and prepared in order to get those approvals from them. Because again, it is challenging to get those approvals, and we have to arm the agents with all the information they need in order to get those approvals. Now, the alternative is if we don't qualify for citizens, we don't qualify for the ground up, our alternatives would be the layered programs. Those, again, because there's no regulation, these are not, like citizens, a state fund program, or an admitted carrier that's regulated by the state. These are non-admitted carriers that are not really regulated, right, by the state. So they can charge basically whatever they want. They can have whatever deductibles they want, throw in whatever exclusion they want. So again, it's very important to look at all the specifics that go into the layer programs. And again, hopefully be able to find full coverage for the buildings. We will talk about not being able to find full limits in one of our further questions, but definitely that would be my recommendation. Start the process early. If the board, if the association is not happy with the current agent, start that broker selection process. Pick the best agent, pick one agent that can actually go to the entire market and secure the most competitive terms.
Right.
And then with that, I know we mentioned appraisals a little bit ago, but I will tell you something else that we're seeing in the market. Again, in the past, we didn't see much of an issue with appraisals and valuations going up. And they used to go up anywhere between 2 to 3% per year. And it wasn't that significant, especially when we were in a soft market and premiums were dropping. Now we're on the opposite. Premiums are rising and valuations are rising even more. So I will tell you also this, that after Surfside, that's when we saw a shift in the market with the carriers and the expectations for valuations. What happened was that underwriters and carriers realized that many properties, many buildings were undervalued, therefore underinsured, right? And so they started having minimum cost per square foot requirements in order to get the buildings up to where they're comfortable insuring them. And Drew, I will pass this on to you because I know you're the expert in appraisals, but I think it's important for everybody to understand why we're seeing this huge increases in valuations since last year.
Yes, that's correct, Pam. So what we have seen in the last 30 years, or should I say, this is historical, what we've seen in the last 3 years compared to what I've seen in the 30 plus years I've been doing these appraisals. So first of all, the state requires you to get the appraisal done once every 36 months. So what we are seeing in terms of increases for 36-month-old appraisals that were done in 2020, we're seeing increases anywhere from 32 to 36% increase in value alone, just for replacement of like for like. The 2-year-old appraisals completed, say, in 21, we're still seeing 22 to 25% increases from appraisals that were done just 2 years ago. As you know, inflation has just been runaway for the last couple of years. The one good thing, I guess, if you want to call it a silver lining in all this, is that it's finally started to cool down. The appraisal values that we have seen, and we track this, so we get cost data constantly coming in every 30 days as far as what the market is doing. We also see what they're forecasting. But in terms of what appraisals that are, say, 12 months old are, we're seeing 1 to 3% increases maximum, essentially flat on some of the appraisals, depending on the type of construction you have. So, it's sort of a double-edged sword, depending on how old your previous appraisal is. Obviously, if you haven't done one in 3 years, there'll be that probably 30+% increase. If you've had one done every 12 months, you've already absorbed the lion's share of that increase. And so hopefully you won't have any major jumps like you've had the last couple of years. Whether or not, this trend will continue, I suspect it will. At least they're forecasting it to be flat. In fact, almost deflationary a little bit, which we rarely see. I mean, we saw that after the 2007 real estate collapse, but other than that, it's typically a modest increase, unlike what we've seen the last couple of years, Pam.
Great, great. Thank you both.
Yeah, that's a great point.
Yep.
I was just gonna add, like Paul was, like Drew was saying, just to keep that in mind, especially for budget season, if the association is due for an appraisal, to take that into consideration when preparing those budgets.
Okay. And make sure you do it as much
Paul,
time as you
can I
can.
can I add one piece to that? Because I think it's an important carryover, kind of from a different direction. And listening to what Pam and Drew just expressed, there's a lot of complicated issues going on with this topic, obviously. I just wanted to point out that, you know, I have recognized, and I know management certainly has, a lot of associations, the unit ownership, the membership are looking towards the boards as maybe doing something wrong because they're coming back to the boards with to the community with these massive increases and trying to best explain why the assessments have to be modified due to these very drastic, incredible situations that are going on. I would just ask the you know, those that are unit owners need to, you know, understand that is the duty of the board, and the boards need to address these very complicated issues. And I don't think that they're really in the place of being criticized for addressing these issues. I guess the bottom line is the fact that these prices are fluctuating so significantly, and the end of the line is coming to the unit ownership, which we're going to talk more about. I would just ask that the membership should really pause a minute and recognize that these are things that are predominantly outside of the control of the board of directors. These increases, their duty is to inform the membership as to what's going on and best try to plan for this and make sure that they've covered all of their diligence. But you know, the bare fact that the prices are going up should not be reflected on the poor, you know, performance of a board of directors. So I just want to emphasize that, you know, for those that are listening, they should probably carry that message along to their community, that you know, the bare fact that the prices are going up is not a reflection of any kind of malfeasance or lack of diligence by the board. It's because of what's going on in the market.
Good,
Absolutely.
good.
Just one point on the appraisals is that, you know, like I said before, carriers now are imposing their own valuation requirements. So sometimes associations may have an appraisal that's a year old, 2 years old, but the carrier is saying that cost per square footage is still too low. Then minimum we can accept is, you know, $175 per square foot or 180, whatever that requirement is for that particular carrier. So in order to avoid the carrier just imposing higher valuations, having an updated or current appraisal, even within that last year, right? Because sometimes 2 years old could be too old for them. So having current appraisals definitely will help the association and the board, going back to Gary's point, do their due diligence in order to say, okay, if we just leave it up to the carrier, we would be paying even more because of the imposed valuation that they would have. So certainly having those updated appraisals are very, very important.
Good. Thank you, all three of you. So Lynn, from a property management standpoint, what support can property management companies provide to boards in their efforts to secure the most competitive insurance rates?
Yeah, these days, you know, I'm seeing just a lot of questions about what did the board and management do to ensure that the property has the best possible coverage in terms of these rates. They want to know that we just didn't accept the first proposal that was thrown at us and just, you know, go through a renewal, you know, similar to how it's been done in the past, you know. So I would suggest starting with a very direct conversation, you know, with your existing broker. You know, tell him or her that as a board, you know, you're looking to get the most competitive quote possible, and that they really need to explore any potential cost savings that may be there. You know, I think it's also smart, as Pam mentioned, to also let them know that you're considering interviewing other brokers as well. You know, to make sure just that, one, that the association is indeed getting the lowest possible bid, and two, so that you can share with your constituents that you did indeed go out there and seek any and all alternatives in this crazy market. You know, of course, you know, your property management team can certainly assist in identifying, you know, additional brokers in the event that you do want to interview other ones. You may find, though, that when you are in the process of interviewing these other brokers, if you are already with an admitted carrier, that broker is probably going to tell you to take the deal that you already have with your existing agent. So as Pam mentioned, so an admitted carrier is one of the ones that they have to have their rates approved by the state's Office of Insurance Regulation. So this office works on behalf of, consumers like all of us, to lessen these increases. So you may think, that your rates are way too high, but if you are with an admitted carrier, the increase is actually likely less than it would have been, otherwise. But to me, I think that the most important thing for everyone to consider, though, is to make sure that you have a clear understanding as to what's being quoted. Because a broker might feel, the need to, to reduce those costs, and maybe there are exclusions, like Pam mentioned, and therefore it's not apples to apples with what you think that you're getting. And it might look appealing because it's less expensive, but it's essential, really, to know what it is that you're getting quoted, so that you don't end up with a policy that might exclude something that happens all the time at condos, such as water damage, from a leaking pipe. That's one of the exclusions that they might even have in there. So, through a company like us, our First Service financial team, of which Pam is a part, we offer, a wide variety to support the properties in terms of both banking and insurance. So, we encourage our management teams to reach out to Pam, and review any of these new policies that are being quoted before they're bound. Just to make sure that the property really does have a full understanding of the coverage, to ensure it makes sense for them, because in some cases it may not. We can also assist in providing guidance regarding current rates and the market conditions. But lastly, I really think that, managers should work with the regional directors, with vice presidents like me, your insurance agent, to prepare a short summary of what was done to ensure that the building has these best possible rates, and give that comfort to the community too. Invite your broker to your renewal meeting in person, so that the community can ask those tough questions directly to them. But communication is key in this time. So, if you don't tell the story of everything that was done, people can, they think something else. They may think that no due diligence was done. So really just, explore the market, to the best that you can, and just communicate a little bit. Sometimes education goes a long way.
So, Lynn, it sounds like a lot of support from the management company, but a lot of proactive support as well. And I know that Pam obviously is an expert, and she has a team of people that work alongside her and behind her. But she actually, I just want to be clear, she only services First Service residential clients.
Absolutely. Yes. Just to add to that, Paul. Yeah, my role at First Service Financial is to do that analysis, that review of the current program, and then identify opportunities for improvement, whether that is in terms of premium, potential savings, or minimize increases, deductibles, remove exclusions. So again, part of my role is to do that first initial analysis review, work closely with the board and management team, and then again, identify if there's any opportunities. If there are, then that's when we could certainly start that bidding process, the agent selection process. And I think a lot of times board members may be overwhelmed by the process, because again, insurance is very unique, the way that the process is done. So I really work as a consultant with our properties to assist with that process, to make it easy, and to ultimately help the association obtain the most competitive terms that they can. And again, part of, like Lynn said, it's important to have the agents be part of those meetings with residents, and also have them provide a full marketing list of all the companies that were approached and the responses. Because again, a lot of times residents may just say, well, what about other companies? How come we're only dealing with one quote? And when you see that marketing summary, you may be able to see that no other carrier was able to compete or provide terms. So it's important, I think, to have those marketing lists and provide those and share them with residents.
And just to piggyback on Pam, your point, I know we've all experienced the professionals on the webinar, that some associations, which is a very common thing, you're using one of these preferred agents that have vast experience in the condo market, which is highly not only required. I mean, it's not just best; it's required, because they work in this particular field. But it's a common practice right now to have somebody knows somebody was a previous agent or broker in the general insurance field, and they feel that they can go towards that marketplace and try to acquire insurance, and it's just unfortunately a lost leader because it doesn't get you anywhere close to the type of insurance that a condominium association is required to have, and it really misdirects the unit ownership and the board going down that route. So I would just emphasize the fact that whichever agent you use has to be an agent that is well versed in the condominium arena, and they're very familiar with the products that are available in the market. Because if not, and we've seen some associations that have gone off to a different world, it has created huge liability for the associations because they're extraordinarily underinsured. So it's just, please just stay with people and companies that are in this marketplace.
Yes, that's great, Gary. And also one last point on this is that insurance agents sometimes will come to board members and sell them all of these things, right? And they'll say they can get the lowest premiums, they can save them hundreds of thousands of dollars, and they just have to sign this AOR, this letter. And the boards may not really realize what that letter means and what that it entails. So I think before, I would suggest every board member listening to this webinar, before you sign an agent of record letter, make sure you consult that with your management teams, with someone like me, where we can actually tell you what that's going to do, which basically is going to fire the current agent. And if that's not the intent, we need to be very cautious with this, because that will create certainly a lot of confusion in the marketplace, because insurance companies now are not sure which agent they're supposed to be dealing with, and they may be receiving conflicting information from different agents, and that could potentially turn into a declination. So that could certainly hurt the association. So we have to do this very cautiously and just be fully aware of what the next steps are and make sure everybody is on the same page as far as the next steps in terms of the renewal.
Great. Thank you, Gary and Pam and Lynn. But Pam, while we have you, so each set of condominium documents sets out a certain set of insurance limits that are required. So what happens if associations cannot get those limits?
Yeah, that is something that we're seeing this year. This really wasn't a concern last year or any year previous to 2023. And that is part of the capacity that I was referring to earlier in the conversation, where insurance company may only be able to provide $2.5 million, $5 million to certain buildings. And it's not ideal, right? Because now the association is not in compliance with Florida statute, which requires associations to be insured to 100% of the replacement cost based on an appraisal done in the past 36 months. So we talked about the appraisal, we talked about now the statute. Also, Gary mentioned the condominium documents, and those are very particular as to what is required. And again, they will typically be aligned with the statute in terms of 100% replacement cost per appraisal that was done in the last 36 months. And most condominium documents that I have looked at will also state that the policies should have special cause of loss. And basically what that means is that special form basically is the form that includes wind coverage. When we're seeing these sub-limits only really apply to wind coverage, right? Because we can have a carrier or multiple carriers that can insure the building for what we call X-wind. And that's basically all of the perils, collapse, water damage, fire, everything else other than wind. The wind coverage is the one that has been very challenging this year. And that is the one that carriers are having issues with the capacity and how much they can offer. So again, if the association does not qualify for more than $10 million, that may be it, right? They may not qualify for it. There may be not anything they can do. And in that situation, I would just let the board know to obtain that marketing summary, something from the insurance agent saying, we went to the entire marketplace, this is the most we were able to secure. And it is unfortunate, it is not in compliance, right, with Condo Docs Florida statute and lender requirements. That's something that we haven't even talked about yet. But most mortgages that people have, what happens is that the banks, the lenders, sell their loans to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac have very strict insurance requirements, including deductible percentage amounts requirements. The maximum they allow is 5%. So that could create issues for current owners with their own mortgages, if they're trying to refinance, or potential buyers in the building. So definitely something to keep in mind. And also, you know, just looking at those three things, the last thing that is very important, and when agents, I know we were talking about agents sometimes trying to just get boards to sign agent of record letters, but what we have seen too is that agents will say, oh, you don't need to have to buy full limits, you know, you can only buy a policy for $5 million and save in premium. Granted, it sounds great, right? Because like Lynn said earlier, it sounds great because it's a lower cost, but it's not in compliance. Now, the biggest issue here is that the D&O policies, directors and officers policies, will not cover the board for not buying, not securing proper insurance. So the minute I tell board members that, then they really tend to reconsider it, right? And again, unless they cannot buy it in the marketplace because it's not available, they should buy it, because otherwise the D&O policy will not protect them in the event that there is a lawsuit against the board for not buying proper insurance.
Right. So Gary, real quick, so we can move on to the next question, but real quick, from a legal standpoint, any legal implications if the insurance limits can't be acquired?
Yeah, I mean, they could be very significant. I'm gonna just, back up right to where Pam left off. There's a difference between not being able to acquire insurance because it's prohibited in the marketplace versus the expense involved. And those are two very different issues. So if it's an expense issue, you are mandated to take out that insurance as the board of directors. You do not have a right. You'd be going completely against your declaration of condominium and arguably the Florida statutes to start defining and stop acquiring certain insurance that you're mandated to maintain. So you would be breaching your fiduciary duty as a board, which then rolls into the point about directors and officers insurance coverage. If you cannot procure insurance for some reason because the market just doesn't allow it, I think that's when we really have to work with specialists like Pam or somebody else in that field, but particularly your agent, to try to find out how we can address that gap. But if it's just an issue of, and I'm trying to minimize it, but if it's an issue of expense, that may not be your option. And we just are going to have to look at, avenues like special assessments or other things to be able to raise capital in order to procure the type of insurance you need to have. I do want to also quickly emphasize what Pam said, because it's something that everybody seems to forget. When you have financing in your building, let alone Fannie and Freddie, most of these mortgages are lending money based upon the insurance being procured by the association in the amounts and types that are defined in the declaration. So failing to procure that insurance by the board of directors could very possibly put the mortgages on property in jeopardy. So it creates a liability for the board. It also creates a liability to the individual unit owners, because the necessary insurance to be able to maintain the conditions for mortgage have not been now satisfied by the association, putting the individual mortgages in jeopardy and creating a liability between the unit owner and their financing, banks or financing entities. So please be very, very careful. These are very important decisions. It goes back to the point I was trying to make a few minutes ago, that these decisions are not just about, the money's going up, the board isn't doing their job, how can you increase our expenses through our assessments? That has to be very well understood and expressed to the unit ownership, because there is possibly no option available, and these are things that have to be done. This is not an option. Like somebody living in a single family home can choose not to take out wind or some other, insurance component. That is just not an option available for most associations.
Great.
And again, great advice there. Just communicate that to your residents. Communicate that, in writing. Send that out to people when they have those questions about insurance. I do see that once that education component is presented, that we can't jeopardize everybody's mortgage. You can't go against your condo docs. These are all things that once people understand that there really are no other options, sometimes, you do have to bite the bullet and pay for those expensive premiums. And yes, we do see that even great, properties are getting canceled right now. They may even have had very few claims. and be a relatively new building. And still they're seeing that their policies are getting canceled. And therefore, when these premiums are going up, sometimes 100%, it's, you know, it's brutal. And, you know, communication is the key, because as much as we would like to say that, you know, you could go with the lower limits or something, you know, it's just, it's not something that can be an option, assuming you are able to procure that coverage somehow. It's going to be expensive and it's going to be painful, but it is something that does need to be done.
Great point, Lynn. Thank you. So why don't we move on to reserves? I think we actually probably should have scheduled this for 5 hours today rather than 1 hour. But we're going to try to get to as many questions, and then we'll do a follow-up with your questions after the webinar. But let's go on to reserves. So as we know, Florida law requires condo annual budgets to include operating expenses and reserves for capital expenditures and deferred maintenance. So to properly budget for reserves, condo associations must conduct a reserve study. So Gary, tell us a little bit more about Senate Bill 154 and the new reserve study requirements, and then what exactly are the requirements for the SIRS that we mentioned earlier, is the structural integrity reserve study. So Gary, why don't you give us maybe a minute and a half, and then we'll go to Drew.
Sure, Paul. Start your clock. Okay. So again, just to set the stage on this. So last year, not this year, the state legislature decided to address the safety reforms that were directly connected to what was perceived to be issues that resulted from the Champlain situation as a general concern. One of the areas that they hit, which we're not going to be discussing today, are the milestone inspections that are now going to be required for buildings that are 3 stories or more, that are 30 years in age, and based upon their location, an even earlier report could be required. And that is to essentially evaluate the conditions of the building from an engineering or architecture perspective, report on it, and start addressing essentially structural components of the building at a broad swatch in the context of ensuring that the engineering and the construction is all sound. The second side to all of that was the advent of a revised reserve requirement. So just to remind everybody, reserves are old statutory requirements. They're very much a part of 718, which is the Condo Act, and they're required for every association. Every association budget must have an operating component and a reserve component. Historically, you could partially fund or waive reserves by a vote of the ownership. And you can also move reserve funds out of the reserves into operations, also with the vote of the membership. So between last year and this year, because there were some reforms this year on the bill, there was a statutory requirements, SIRS, which is what we're going to refer to it as, which is the Structural Integrity Reserve Study requirement. It has to be completed for residential condominiums that are 3 stories or more in height, as determined by the Florida Building Code. These reserve studies have to be performed every 10 years after the first one, and must be completed by December 31st, 2024 for associations existing on or before July 1st, 2022. Developers must perform this study before turning over associations to the unit owners as a new mandate. These reserve studies have to be performed by any person qualified to perform such studies. They could be an engineer, an architect, or professional reserve analyst who's properly licensed with the state of Florida. The reserves must identify each item being visually inspected, state the remaining expected useful life and replacement costs, and provide reserve funding schedule with a recommended annual reserve amount that achieves the replacement or deferred maintenance costs of each item being visually inspected by the end of the estimated remaining useful life of the item. Regarding the reserves themselves, the amount to be reserved for an item will be determined by the most recent Structural Integrity Reserve Study. For a budget adopted on or before December 31st, 2024, members that must obtain a SIRS may not determine to waive, provide less, or use reserves for any other purpose but for their intended purposes. In other words, they are not allowed to be waived. SIRS reserve components are not allowed to be waived, partially funded, or moved out of the reserves starting as of a budget that's adopted on December 31st, 2024 and forward. The categories that have to be now addressed in the SERS include roof, structure, including load-bearing walls and other primary structural members and primary structural systems, fireproofing and fire protection systems, plumbing, electrical systems, waterproofing and exterior paint, windows and exterior doors, and the grand catch-all, which is any other item requiring replacement or repair cost that exceeds $10,000, and the failure to replace or maintain the item negatively affects any of those components that I just mentioned. The association may adjust replacement reserve assessments annually to take into account inflation adjustments and any changes in estimates or extensions of the useful life of the reserve items as are determined. The structural integrity reserve study may recommend that reserves do not need to be maintained for any item for which an estimated useful life and an estimated replacement cost cannot be determined, or the study may recommend a deferred maintenance expense amount for such item. The SERS also may recommend that reserves for replacement costs do not need to be maintained for any item with an estimated remaining useful life of greater than 25 years, but the study may recommend that that expense also be captured. Developer-controlled associations, to wrap this up, may not vote also to waive reserves or reduce reserves. Officers or directors of an association that willingly or knowingly fail to complete the SERS or mandatory milestone inspections will be in breach of the officers and directors' fiduciary duty. That's baked right into the statute. And last but not least, a copy of the study is considered to be an official record and is open for inspection to the ownership or their representatives for a period of 15 years. How's that, Paul?
That was great. You hit it right on the minute mark. So thank you.
I'm sure I went over, but I tried.
We had to have an attorney on this, huh?
Okay, sorry about that.
All right, Drew Isaac, reserve study expert. What do you have to say?
Well, in my 20 seconds that's left, I'm going to go over everything. No, I'm just going to cherry pick a few things that, based on the kind of calls and conversations we've been having with clients and prospects. So the SERS items, which Gary listed, one of them being structure. People are asking, do we have to put the value of our entire structure in there? And the answer is no. This is determined by the person preparing it, but that's an unreasonable thing to think. What I think we're looking at here and what we're doing is putting in a restoration allowance, stucco, concrete repairs, things of that nature, which can be, obviously millions of dollars depending on the size of the property. So don't let that description throw you. We're looking at trying to cover realistic expenses. The other thing, which is new, which part of the SERS, is windows and exterior doors. Windows, if they are the association's responsibility, are a required SERS item. Don't assume that the unit owner is responsible for their own windows. While a lot of those declarations state that, not all of them do. I can tell you for a fact, get a legal opinion, and whatever it is, we'll deal with it. But don't just assume, because windows are a very expensive item. Obviously, if the association, it's determined they have to replace those windows, everyone's, we're looking at millions of dollars easily. So that's something that does need to be investigated on the association side. And the last thing is, the SERS are required once every 10 years by statute. That is really an unrealistic timeline. Reserve study standards recommend every 3 years. These are changing costs, changing balances, and quite honestly, it could work in your favor. If you've had to do a SERS and you haven't been funding fully in recent years, you're probably going to be hit with a lot of sticker shock. But after you start replacing these items, then your full funded amount will probably come down. So we recommend every 3 years, but the statute does say every 10 years. So keep that in mind.
Great. Thank you, Drew. Lynn, so as a result of the legislative changes that we're talking about, there's a lot of communities in Florida that are obviously rethinking their reserve funding strategies, and many communities are underfunded and really need to catch up. So what do you feel that condo boards can do if they aren't quite where they need to be?
Yeah, I think a lot of communities will, or, certainly are finding themselves in this same predicament, between needing a new appraisal, planning for these SERS components in 2025 and fully funding reserves. It can seem very daunting for everybody, but it is important to remember that you don't need to get caught up in just 1 or 2 years. You just need to start the fully funding process. So fully funding is different than full funded. So, you just need to look at your reserve study and fully fund those reserves for that year. The deficit will be funded over time, of course, depending on the components and the lifespan remaining. And again, while it does seem like it's a tough mountain to climb, fortunately, I am seeing residents much more receptive to the increase in reserves than I am, with the skyrocketing insurance. That one seems to have everybody up in arms. But when it comes to reserves, your residents do generally understand that the healthy reserves benefit the building, they benefit the residents, they positively impact resales. So, assuming that you are just following the statutory guidelines on this and going through the process, there may be a little education, of course, involved, but we are not seeing the same sort of pushback, from the residents when we communicate this one. So a little bit of silver lining there.
Drew, anything to add since you're the reserve study specialist?
Yeah, just real quick. It's the definition or the explanation or understanding of full funding versus fully funded. Full funded, let's say you have no reserves for a 20-year roof that is 10 years old. So the roof has already used up half its life. You do a SERS, they're going to tell you you need to fund the entire cost of that roof over its remaining 10 years. So essentially 1/10. That's what your full funded reserve would be. A fully funded reserve is when that same roof, let's say, is 10 years old and you've been collecting reserves and you actually have 50% of the cost of that roof already collected. So you've been fully funding that roof all over the same amount of time. And then, of course, your reserve full funding going forward for that remaining 10 years would be less than, say, your neighbor who hasn't funded the same roof. So just to keep an understanding of those two terminologies, because it does confuse a lot of people.
Okay, I appreciate that. So Lynn, kind of to follow up, how are the first service residential managed communities managing the new reserve requirements? And are there any obstacles that maybe people should be aware of?
I mean, without a doubt, the biggest obstacle right now is timing. Your reserve studies, like Drew, are booked far in advance, and you need to account for this. So engineers likewise are booked way in advance for investigating the structural components. Appraisers do. So given these new requirements that go into effect for all of the buildings in 2025, the time to get on the schedule with these companies is now. You can't wait until halfway through 2024 to start contacting these experts. So, through First Service, we do encourage our managers and our boards to, to attend the webinars on these topics. Meet with your legal and your accounting experts. Ensure that you have the full picture out there, and just get on the books right now with your experts.
Thank you, Lynn. So before the new legislation, waiving reserves was an option for associations, sometimes a popular option for those that were looking to manage their annual expenses. So how has this changed with the updated legislation? Gary, why don't we start with you, and then Drew will have his 15 to 20 seconds.
Like what I said earlier when I was explaining the SERS requirements, you're no longer allowed for those components that I listed. You're no longer going to be able to waive or partially fund those components. They're going to be fully required to be funded, period. Now, I'll let Drew speak to it because he's been doing it, but I know a lot of associations are breaking up the SERS moving into the, looking at 2025, they're looking at breaking up their analysis into the SERS packaging and then non-SERS related reserves. The non-SERS are allowed to be waived and partially funded. Big caveat to that is that to do that now requires a majority of the entire membership. Prior to the newest legislation, it was a majority of a quorum of your membership. So there was a lower threshold to waive reserves in the past. Current legislation requires a full majority of the membership, and that's for non-SERS related reserves. So the bottom line is we're going to need a fund. All SERVs are going to have to be funded, and the boards of directors are not going to be able at this point to be able to address it. Last point on that is the latest legislation has indicated that there may be some funding mechanisms that may be put into place for those associations that are having true difficulty in raising the necessary capital, particularly, I guess, those that have never funded, that have been waiving historically. So there may be some creative things coming out of the state legislature and or Department of Business and Professional Regulation. We haven't seen anything, but there is a possibility that there will be some vehicles available.
Thank you. Drew, anything to add?
Yeah, just very quickly, those associations, condo associations that are not required to get a SERS, don't forget the traditional, what we consider traditional or long-running reserves are still required. Roofing, painting, paving, anything over $10,000. And as Gary said, the bar for waiving those is a majority of the membership versus what it used to be, which is a majority of the quorum. So just because you're not required to get a SERS, you're still required to do your traditional reserves as you've always had, and the waive them is going to be more difficult.
Got it. All right. So we're coming up on time, but two really important questions for Drew, and then Gary, you can chime in from a legal standpoint. But one is, can boards use their current reserve study to fulfill the requirements for SERS, and can boards use their reserve funds to pay for the SERS?
Well, first of all, the SERS was a creation of the Florida legislature in 2022, and it never existed before anywhere. And so the reporting requirements are new and different than anything we've done before. So your existing reserve study would not meet the requirements of the SERS. That being said, for most of them, if it was properly done, the majority of the data is probably very similar to what you are going to need in your SERS. So the bones or the framework is already there. So it may be that obviously we have to, as Gary mentioned, we have to basically split these into what the SERS requirements are and then everything else. So what may be a single schedule of reserves for an association will break into two schedules at least, a SERS and I'll call it a non-SERS. So that alone is a new reporting requirement. So the long answer is no, your current reserve study wouldn't work to meet the requirement, but it will get you, it's certainly the basis for what your SERS will be.
Okay. Gary, anything to add?
No, let me hit your second question about boards using reserve funds to pay for SERVs. Certainly, funds are, reserve funds are reserve funds, and I just, again, to emphasize what you're saying, that using roof as an example, roof was something that needed to be reserved as a component prior, so it's not changing. There's no additional requirement now that it's on the SERS list. It's just going to be part of that, and what you do with that money is going to now be more difficult to, it's going to be controlled more, but it's the same. So nothing changes. Your 10-year-old roof in 2021 is your is maybe your 7-year-old roof in 2023. So there's not going to be any significant changes to that. So it's just moving into a different category of evaluation. The one thing I do want to make the point of is that there has been some concern about, using reserve funds to do things with, including funding or loans out of reserves. There is no ability to do that. So nowhere is that allowed. That continues to be the case. So, kind of moving the front end of this webinar to the tail end of the webinar, just as a point, if you are trying to raise capital with regard to insurance needs, you cannot use your reserve funds as to loan money into your operating. It doesn't exist for that purpose. But so just to make that point, but again, the boards can use the reserve funds to pay for SERS because the components are going to be similar, and there's going to be additives possibly, and that those monies are going to have to be collected in addition to the previous.
Perfect. That's excellent information and very important, so you stay out of trouble. So last remarks, we are up on time. I'm going to take it a few minutes over because we want to make sure that we address any key takeaways from the panelists. But thank you all for being here today. We appreciate it. Pam, any final takeaways or words of wisdom that you want to leave everyone with?
Yeah, I would say definitely start early. And when I mean early, I mean about 120 days in advance, about 4 months in advance. That's when the market's open. That's when insurance agents can start working on submissions. So definitely start early to prepare the associations for the renewal.
Awesome. Pam, thank you for being here and taking the time. We appreciate it.
Thank you so much.
Drew, how about you? Last minute takeaways.
Sure. Because of the overwhelming demand and the upcoming deadline, which is basically 13 months away, you've got to get your SERS contracted now. I hate to say it, but there's just not enough qualified professionals for all the demand that they've thrown at us. So we've been getting a lot of proposals and a lot of contracts, but if you're one of those ones that hasn't really started the process, you need to do so.
Right. Thank you, Drew, and thank you for being here today. We appreciate it and all your
Certainly.
expertise. Lynn, final words, takeaways from you.
I think the other experts made the point very clear. You've got to start now. Do not delay. So aside from that, communicate. Make sure your residents understand everything that is going on. Educate them on the process and what the board and management is working on. I think that's key. And I just would like to thank everybody for joining us here today.
Right. Lynn, thank you so much for you and your time as well. Gary, last minute takeaways from a legal standpoint.
Yeah, it's really piggybacking on Lynn's comment. I just, I've seen some really good boards of directors getting really, in trouble by their community because they're doing what they need to do. I think there is a high level of education needed. I don't think it's a lot that needs to be done, but understanding what is going on, why it's happening, would be key. I would certainly recommend on the insurance issue that if and when you're meeting with your community on the budgets, I think Pam mentioned as well, please bring your agent in to explain what has been done, what the diligence that has been gone through, explain it to the audience. Hopefully, the reasonable people will understand that these are unfortunately not options, or they're limited options, and they are mandates that we have to comply with. So, the board should not be put into a position of being excised or criticized to a high level if there really is no option. So I again, just educate and communicate. I think that's a great term.
Great. Gary, thank you. And thank you for being here and for your time. We appreciate it.
Thank you.
Not every day we can get free legal advice, so we definitely appreciate it. All right, so we got a lot of questions for the event today, both before the event and during the event, all of which are important to us. So we didn't have a chance to get to all of them. So someone from our team is going to be following up in the days to come to make sure that you get the answers to your questions. So we'll make sure that we follow up with you on that. For educational materials designed specifically for association board members, you can, of course, visit the First Service Residential website, which is fsresidential.com. And then finally, just as a reminder, today's discussion and conversation represents perspectives from our panel of experts. This should not be relied upon as advice specific to your association. As always, consult your professional partners, like Gary and his firm, Drew and his firm, Lynn, myself, insurance agents, to determine the best course of action for your association. So we thank you all very much for attending today. We will be sending out a follow-up to this and a recording, and we'll see you next time. Thank you very much for joining.